Okay, Chapter 6, Accounting for Merchandising Business. And what we'll do is, I tried to keep this chapter simple, but I guess it still feels like you don't know enough of what's in the chapter. So I'll go through what's in here and we'll focus on exactly what you need to know. These are the learning objectives for this chapter. First, to distinguish between the activities and financial statements of service versus merchandising business. Okay, this is the whole point right here. That's what we're looking at. And then to look at the accounting for merchandise transactions. Okay, the center of the chapter has a piece on the adjusting process for merchandising business. We are not going to do this. You don't have to worry about it at all. So literally just skip over it. And then, but what I do care about though are the financial statements of a merchandising business, in particular the multi-step statement. And there's one in, you've got a couple good illustrations in the practice problems. And then the use of the asset turnover and evaluating a company's operating performance. Now see, you've actually already learned a lot in Chapter 1 and Chapter 2. So, I mean, that steep learning curve that you had before really isn't in this chapter. Okay, because you know the accounts, you know the words, you understand the concept of balance sheet and income statement, right? Okay. So first, a merchandising business. Service and merchandising are very different, and it's reflected in their operating cycles and their financial statements. And when you think about an operating cycle, it's the process by which a company spends cash, makes revenue, and receives cash. Okay? That's collected later by like collecting accounts receivable. So it's that whole cycle. And I think there's a pretty good illustration of it in your book. But that is your operating cycle. And they're different lengths for different businesses. And here it is. So here we've got, first of all, we take cash and we buy some merchandise. Then we sell it to somebody. We get an account receivable. The money comes in. And this keeps going. And that's our operating cycle. And they've got a couple of examples here. Like if you're working in a grocery store, like milk doesn't hang out there for 3 months, hopefully, okay? Grocery store, actually the items turn around in about 2 days, depending on where they are, but it's pretty fast. But that is in contrast to a jewelry store where expensive items are often displayed for months before they're being sold. Okay, so this would have a very long operating cycle, whereas a grocery store would have a fast one. Or short one. And then their financial statements are going to be different. And this is what I want you to be able to really understand and have in your head. For a service business, we had fees, fee income, fee revenue, operating expenses, and operating income. Now we're going to add a couple things here. Now we're going to have sales. All right, we're going to subtract the cost of sales. The cost of the merchandise was sold, and then we're going to have gross profit. Okay, gross profit. And then we've got operating expenses that will come out of that, and then operating income. And just like the financial statements that we looked at in that extra credit quiz, all right, they had sales, cost of goods sold, and gross profit. Every company had that. So the revenue activities of a service business, they provide services. And on the income statement, revenue is from services is called fees earned. And operating expenses are subtracted from it, right? Whereas the revenue activities of a merchandising business is buying and selling merchandise. So think Walmart or Target. Merchandising business first purchases its merchandise to sell, and then when they sell it, that's reported as sales. The cost is cost of merchandise sales, and the cost of merchandise sold. And the difference between the sales and the cost is gross profit. Okay, that's the profit before deducting operating expenses. And this is a standard format for a financial statement, okay, for a merchandising company. Merchandise on hand is merchandise inventory. All right, if we still have it and it's not sold, then it's an asset. And it's a current asset on the balance sheet. And here's an example. This is in the current year, merchandise is sold for $250,000 in cash, and for $975,000 on account. So our total sales are $1,225,000. Okay, the goods are gone. We have a right to receive the cash. We've earned it, so it's considered a sale. Cost of goods sold is $735,000. So our gross profit would be the difference, $490,000. Okay, and I think that's it. And we'll get into more detail in the next presentation.